Thank you, thank you. So, how has the Kellogg Company performed since tonight's guest took over as CEO? Well, to quote a corporate spokesman, the answer is, great! My apologies to Tony. Carlos Guiterrez is a classic American success story. He's revitalized an icon company almost a century old. He shared a stage with Muhammad Ali. His company sponsored NASCAR, won a championship. You don't get much more mainstream USA than that. But really, his story doesn't begin in Battle Creek or even America. It begins in Cuba in the 1950s, where he grew up. Carlos Guiterrez's family was part of Havana's successful business community, where his father ran a thriving pineapple plantation. Then in 1960, after Fidel Castro seized power, the family fled to the United States. At first they settled in South Florida, figuring their exile would be temporary. When that hope proved elusive, his father followed job opportunities around the United States and eventually to Mexico. That's where Carlos studied business administration at the Monterey Institute of Technology, met his wife, and took his first job driving a Kellogg sales van in Mexico City. And in less than a decade, he was running the company's entire Mexican operation. He took a plant that consistently finished dead last in Kellogg's internal rankings and transformed it into a company-wide model, #1 in productivity and cleanliness. His rise through the ranks continued. In June 1998, he was appointed President and Chief Operating Officer. 9 months later, he was named CEO, the youngest in the company's history. This is a man who not only knows that Snap, Crackle, and Pop are brothers, he knows which one is the oldest. I wouldn't be surprised if he knew all the words to their latest hit song. We won't ask him to sing for us supper tonight, but we are pleased that he's here. So, ladies and gentlemen, please join me in welcoming the Chairman and Chief Executive Officer of Kellogg Company, Carlos Guiterrez. Thank you, Jim, and that was a very kind and warm introduction. It's a real pleasure to be at this occasion. One time I was here when President Fox was here, and I was sitting on the dais. That was about 2 or 3 years ago. I didn't realize it was such a long way from sitting down there to coming up here to the podium. But it truly is a pleasure that I honor quite strongly. I wasn't sure at first because the date was April the 1st. I wasn't sure at first if that was a symbolic, if it was the black tie was the joke or what. But seriously, it's always good to be in Chicago. Kellogg has a special relationship with the city, formed back when our founder, Mr. Kellogg, teamed up with Leo Burnett. That was more than 50 years ago in this city, to produce what we believe are some of the most innovative and memorable advertising ever seen. I know there's some people here from Leo Burnett, and there's a lot that we owe them just in terms of the value of our brands and the strength of our brands. And that has helped turn Kellogg into one of the most trusted names and recognized icons in the food industry worldwide. Our Chicago ties have become even stronger with our acquisition of Elmhurst-based Keebler Foods a couple of years ago. And so what I thought I'd do tonight is just put it all together and talk a little bit about what we have had to do as a company in terms of challenging existing assumptions, challenging existing beliefs, and actually going after them and changing them. Rethinking long-held notions, and for a company that's been around for 100 years, we have a lot of long-held notions.
You can imagine that. And I'd like to put that into context of our own progress at the Kellogg Company. Now, one of our core values at Kellogg is humility. So the last thing I want to do is come across here like I am lecturing on the turnaround of food companies, or that somehow we at Kellogg have a special formula for corporate turnarounds. We don't. I'll just tell you what we did, and if there's something for you to pick up from that, that's great. In fact, I think the word turnaround is a little bit overly used. I always get a little bit suspicious when I hear that a company was turned around in 18 months. Interestingly, about 2 years ago, I was here in town. I was speaking with Dan Jornt, who I know can't be here tonight. He's on our board of directors from Walgreens. And I asked him, because Walgreens, as you know, has been quite a success story. I said, Dan, how long did it take you to turn around Walgreens? And I braced myself, because I thought his answer would be 18 months. And I had been in my job for 24 months at that time. And his answer was, and he looked at me with a straight face, he said about 20 years. And he meant it. And it had been 20 years of just determination and will and going after a plan and sticking to it. And I think today, you'd probably ask them, and they're still turning the business around. So there's obviously no magic bullet for revitalization that works for everyone. But I do believe that challenging your own assumptions and being able to look at your own history and challenging what was once your own status quo can lead to new answers and new approaches. First, some background, why we needed to reshape our company. And I don't mean to decry any of the previous leaders or to criticize or anything that was done in the past. It's the easiest thing to do. But just give you a couple of facts as to where we were as a business. In the mid-1990s, our universe was growing a bit soggy. There was a steady deceleration in our sales growth. Our earnings had become very volatile. We'd have one good quarter, one bad quarter, one good year, one bad year. And as we wrestled to achieve targets that frankly were unrealistic. So probably the single biggest problem was giving our people targets that, we expected them to do miracles, but we wanted them to come back with those numbers. So in response, we ended up focused on cost cutting rather than building revenue, just so we can hit near-term targets. And worse, Kellogg and other food companies began to rely on price discounting more than brand building. And it's been about a trend of about 10 or 15 years where advertising has been declining, but price promotion has been increasing. And after a while, as you all know, you quickly go into commoditization. Your brand turns into a commodity, and what really counts at that point is price. And price promotion, ironically, back in the mid-90s, the category pricing came down. And probably the worst insult you can ever imagine is that prices went down and category sales went down. Even though people could still buy cornflakes at 99 cents or buy one, get one free. And the problem is that by taking prices down and assuming that people will buy more because prices are lower, we had to fund that with marketing dollars, with new product dollars, with health message dollars, with promotional dollars. And we learned that our business moves not on the basis of who's got the lowest price, but who has the best ideas. And that's a lesson that, as a business, I can assure you, we will not forget. So we had entered a bit of a vicious cycle, one that was leading us to be a company of commodities. As sales slowed, gross margins declined, and as gross margins declined, we continued to cut marketing expenses and did the easy thing, which was increase price discounts so we can push tonnage and volume into the trade. Our competitiveness suffered, and our longtime rival eclipsed our share of the U.S. cereal category for the first time. I can't tell you what an emotional event that is in Battle Creek, Michigan, when you've been leader for 90 years to all of a sudden find that you're number 2 in the U.S. market. So we had to face that reality that we are number 2, that we are number 1. If we measured our business in tons, or in tonnage, or in pounds, or in bushels of corn, we would probably be number 1. But we realized that that wasn't the right way to measure the business. And we are probably measuring the business in volume because that way it kept us at number 1. And we decided to just put volume aside and recognize the reality that we are starting from a number 2 position. Our financial performance was quite disappointing. Our employees were demoralized, as you can imagine. Investors were unhappy. From 96 to 2000, Kellogg stock dropped nearly 20%. In an otherwise booming market. Clearly, the time had come for us to challenge those long-standing assumptions, those sacred cows, those things that you couldn't change because that's the way we've always done it. And what we did is we focused on 3 core elements that would give us the best chance at finding new solutions that could restore growth and create value. And these are our words. We didn't go out and hire and you'll notice that there are words. We didn't go out and hire a consultant to, put some words in our head. We went out and tried to figure it out ourselves. So there is an old, there's a Cuban poet by the name of José Martí who once said that our wine is bitter, but it is our wine. And the words that I will use are a bit clunky, but they are our words. And they're words that come out of our gut. They're words that come out of how we feel we should be managing the business instead of stepping back and hoping that somebody will come and tell us how we should manage our company. So the first thing we did is look at a concept called prioritize to win. The whole idea was don't spread yourselves too thin, prioritize first, understand where you're putting your money. Setting the right measures was the second point, and then finally the last one we called sweat the execution. Each of these challenged some of our more sacred assumptions and allowed us to begin to reshape the way we did business. Prioritizing to win, simply we were spreading ourselves too thin. We had one assumption that was that we should attempt to grow everywhere we can at any cost because one day, sooner or later, there will be a benefit. So if we enter China and we're not going to make money for 30 years, don't worry about it. We'll make money one day. We have to be in China. Everyone has to be in China. So what we were doing essentially in the 90s was we were taking resources out of the U.S., out of the UK, out of Mexico, out of Canada, out of Australia, but especially out of the U.S., and investing it overseas in small emerging markets. But that linkage wasn't always made. So we got to the point in the U.S. where we had gone from having a proud sales force of 500 representatives, and we went to brokers. Why? Because it was less expensive to go to brokers. And almost subconsciously, that money that we saved from the brokers went to fund a new plant in Thailand, or a new plant in China, or a new plant in India. So spreading ourselves extremely thinly, hoping that that growth would eventually offset the mass that we had here in the U.S. in our core markets. So we had this kind of mindset of, if we build it, they're going to buy it. And obviously, business, as you know, isn't that easy. And our mission was, go global. We've got to be global. We have to be the most global food company. We've got to be in every single country. We've got to convert these populations. If we don't invest now, then we'll be in trouble in 5 or 10 or 15 years. I don't know why that's the conventional wisdom. Maybe the countries won't be there anymore. But, you had to go in there quickly. So this drove the way we allocated our resources, the way we were organized. And it wasn't unusual thinking. I mean, conventional wisdom then and now is that we are well on our way toward a global economy, that for better or for worse, homogenization of brands and beliefs around the world is a foregone conclusion, and it's only a matter of time. And that may be very well true. Many industry analysts, especially in our industry, would say that if you were not in China, you would be missing the single biggest opportunity in the world. And that if you did not invest in China, your stock would be downgraded or your stock wouldn't be as preferred as others. We've been in emerging markets for decades. And so it's not as if though we are anti-emerging markets. I grew up in international. I didn't work in the U.S. until I had been in the company for almost 20 years. So it's ironic that I'm saying this. But we came to realize that we are devoting too much of our money overseas in faraway lands where we knew we were going to, maybe break even in 15 or 20 years, and actually undermanaging our single biggest market, which is the U.S. So the whole idea was, again, not to spread our money too thin, but to concentrate it behind our biggest opportunities, the ones in which we are already generating great returns. We've built a great business in the U.S., a great business in the U.K., and a great business in Canada, Australia, Mexico. So we needed to change the assumption that we had to, every year, we had to show that percent of international business had to be larger every year. And that was an indicator of success. So if last year you did 46% in international, and this year we did 47%, it doesn't matter if we made less. We are becoming more global because we were selling more internationally. So what we had to do is obviously prioritize our resources and put our resources first in the U.S. We actually brought money home and closed a couple of facilities. We didn't walk away from these markets, but we did reinvest back in the U.S., not just in people. We reinvested back in our sales force, back in brand building, back in new products. But what we said was, we're going to get it right first in the U.S. before we do anything else, because there's too much at stake. And the U.S. business, frankly, at that time was 50% of our business. And we chose essentially to follow the dollars instead of following the populations. The dollars, as we see them, are in the U.S. and in the big developed markets. The people are in emerging markets, and I think it's going to take a lot longer than what we hear for those two to come together, or for there actually to be a significant change in dollars and population. So we chose to invest where we could win today. Interestingly, but you still hear people say that if you are not in China and you are not strong in China, that you are not a global company. And I would suggest that if you are not in the U.S. and you don't have a strong business in the U.S. and you're not winning in the U.S., then you're not a global company, regardless of whether you're in China or India or Thailand or wherever else. So I think it's a bit of a change in mindset, perhaps not too conventional, but it's the way we thought ourselves through the changes that we made. So we concentrated our resources first on cereal in the U.S. We invested in brand building and innovation and salespeople and sales execution. And then after we got the U.S. right, we moved to wholesome snacks in the U.S., where we leveraged the DSD system from Keebler and generated terrific growth here in this market. It's quite ironic, but we found that our largest growth was coming from the U.S. We finally, after getting the U.S. right, we shifted resources to our largest markets, the U.K., Mexico, Canada, and Australia. So the result has been a marked acceleration in growth and profitability. We haven't, and I really want to make this clear, we haven't given up on emerging markets. We sell our brands in 160 countries. So emerging markets for us will one day be a very, very large part of our future. But today, and over the next 5 years, and even over my career, I can tell you that my story will not be the EPS contribution of China to our company. Maybe it'll be my successors, but it won't be mine. In today's world, we're simply prioritizing the allocation of our capital and putting it where we get the highest return. So today we use that same principle at all levels of the company, and we use it to allocate resources. We make sure that we're putting our money behind the fastest growth ideas and the highest return ideas. We also like the fact that we compete in a few categories. We're not in 25 or 27 or 30 categories. We're not a food conglomerate. In fact, most of our products are pretty close together in an aisle of a supermarket, maybe 2 aisles away, 3 aisles away. So that allows us to take our sales force and concentrate it into a couple of portions of the supermarket instead of having to just spread ourselves all over the store. So we chose focus instead of extreme diversification. And it's interesting that a few years ago, a lot of people made a lot of money by just using the word scale. It was, you have to merge, you have to buy a company, you have to get bigger. And when you asked why, well, the answer is scale. Of course, I mean, it's simple, it's easy. And we actually have challenged that, and ironically, in categories or food companies that are more focused are selling at a higher multiple than the broader, larger food conglomerates. So the whole idea that was really rampant 3 years ago, and it was very much conventional wisdom, that bigger is better, at least in our industry, that whole idea has not proven true. So we have selected to pursue depth over breadth, focus over diversification. We committed ourselves to growing what we had, what we knew how to do, what we did best, which is cereal, wholesome snacks, grain-based foods. And then with the largest acquisition in our history here at Keebler, we were able to expand within our aisle and expand our product line. So again, very focused, but it allows us to do what we do best, as opposed to venturing into categories where we know little about. The second key element that we challenged was the whole notion of setting the right measures. And it also required us to think about our long-term or long-held assumptions. We don't manage the company on stretch targets. And there was a time when I think you would, as an executive, you would be a little bit ashamed to admit that, because there is a great deal of, aggressiveness and machismo in having very high budgets and very high stretch targets. And if you weren't growing at double-digit EPS, boy, you just weren't making it. And we challenged that notion and went out to Wall Street and told them, look, we're not going to grow at the levels that you believe we should grow. We're going to grow at the levels that we believe we should grow at. So setting unrealistic targets makes our people do some crazy things. It sets our people up for failure. It makes them feel like losers. Nobody wins. We end up disappointing. So what we've done is just set realistic targets. They're obviously challenging. We don't want to become a company of sandbaggers. But I think for a food company, the single biggest thing you can do is give your people targets that they can hit. Targets that they can hit and go home and say, darn it, we are the best, we are winners, we hit our numbers. And that isn't by making easy targets, but making them realistic. We believe investors choose food company stocks not for their explosive growth, but for their dependability, their consistency of earnings and consistency of dividends. So by straining to achieve unrealistic earnings growth targets, we are actually becoming the opposite. More volatile, with one good year of growth and then one bad year of growth. So we challenged this whole idea that you had to grow double digit, that you had to have great targets, that you had to impress Wall Street by telling them you were going to do great things over the next 5 years. We lowered our long-term EPS to a place where we feel is sustainable. We actually said it was going to be high single digit, not double digit. It wasn't popular with investors at first, but I think today, if they don't applaud it, I would say they recognize it and they respect the decision. And frankly, other food companies have also begun following suit. The effect of resetting these targets has had a great effect on the company. Employees feel confident and empowered. They're making decisions that will benefit the company in the long term, and we have returned to being a dependable performer. I think we're the only company that I know of that has a policy against so-called channel stuffing or trade loading. So for us, since we want to run the business in a dependable way, we don't need to stuff the trade with, pounds at the end of a quarter in order to deliver the numbers. We want to be dependable and reliable, and importantly, we want to be rational, which is, I think, why people who buy food stocks do so. The other thing that may not sound as profound as it was to us was that we changed what we measure. And I have found that probably the most powerful thing you can do in a company is change what you measure and make sure people understand what their role is in those measures, and then make them feel glorious if they hit those measures. One of the things we had is this mindset in our business that volume is what creates value. So, and by volume I mean tonnage, literally. How many tons of cornflakes, or how many pounds of cornflakes, how many pounds of Raisin Bran. And if you go back to an annual report, a Kellogg annual report in the 1950s, the first sentence is, our tonnage grew for the year. So it was really, really ingrained in our culture. And when someone went up to you in the company and said, how is business? They were asking you about pounds. They were asking you about tonnage, not about dollars. So we were designing products that were heavy, so we could sell a lot of pounds. even though the cost was higher because these were heavy products, but they gave us pounds. And that was the key, was just keep pushing the pounds. Again, we were chasing tonnage, we were chasing pounds, we were chasing an abstract measure that really had very little to do with the economics of the business. So we changed to something that, surprisingly, went from volume to value, and we changed to something called volume to value. And we took out all reports on volume. I can't tell you how our volume is doing. I don't know if it's up or if it's down, but I can tell you how our dollars are doing. And the incredible change in a sales force when they go from measuring pounds and tonnage and cases to measuring real dollars, and how that ties back into how we manage our manufacturing facilities and how we manage our marketing monies, and how we manage rewards for our people. It changed the way we looked at the world, and it really started by saying, let's stop looking at pound reports. Let's stop looking at volume reports. Just to give you an idea, a simple idea, a 12-ounce box of Special K red berries is about this big, and a 25-ounce box of Raisin Bran is about twice the size. And the small product of Special K red berries sells for 15% higher per unit than that bigger box of Raisin Bran. If you looked at it in pounds, if you looked at it in tonnage, it would be a 50% decline because the Special K red berries only has 12 ounces. And the 25-ounce Raisin Bran obviously was a very big box. So the sales force would be out selling the cheaper product because it had more pounds. And you'd be surprised at how much that still goes on in, I don't know if in the food industry, but in industries at large. So what we had to do strategically was focus on adding value to consumers, adding value to our brands, so that they would be willing to pay more for our brands. And we're not at all apologetic about that we are trying to design products that deserve and that warrant a higher price to consumers, as opposed to thinking that we have a future by selling cornflakes at 99 cents. So the result of the shift was more and better focus on the things that build value into brands, on brand building, on innovation, on putting money behind our most profitable products, getting rid of products that weren't profitable, and rewarding people for their sales mix, for what they sold, for how many dollars they sold, not how many tons. So we're creating now what we believe is a sustainable cycle: higher sales, improved profitability, and reinvestment for future growth. But we are convinced that you cannot sell about the same volume, maybe a little bit more volume every year at a slightly lower price and somehow have a viable business. We're convinced of that. Another long-held assumption was that the company was really managed through the P&L. We were a profit and loss statement company. We were worried about margins, and I don't think anyone in business units ever looked at a balance sheet. And cash flow was kind of an abstract afterthought. It was something that people in corporate looked at and they measured it, and the real business people in the field didn't have to worry about that. We thought we were generating plenty of cash, but we took on $4.7 billion of acquisition-related debt. And I'll tell you, that $4.7 billion can really focus an organization on cash flow. And as did some interesting benchmarking, where we found that we had opportunities in working capital, we had opportunities in capital expenditures, we had opportunity in all areas of managing cash, and we know that at the end of the day, what really creates value, what really drives a stock price, is a company's ability to generate cash flow. So we came up with this phrase called manage for cash. And we've made those two, volume to value and manage for cash, the key focus areas for every employee in the company. We said if you're not focused on one of these areas, then you've got to rethink what you're doing. And they both work together. So we are developing new products on existing equipment, which allows us to keep our capital expenditures low and get more money for the food we run through a line. We're replacing products that are low priced on the same equipment with products that are higher in price. So instead of thinking about how many pounds we're putting through a production line, we're now thinking about how many dollars we put through a production line. And these metrics have cascaded all the way down. I can go into a plant, and I do this quite often, go into a plant and go see the spare parts warehouse manager and ask him or her, how much inventory do you have? And it's remarkable the answers I get. 244,322. People are looking at their numbers, and people feel very proud that at their level, they can contribute to things like cash flow, they can contribute to profits. So the idea is getting the simple metrics and then cascading them down as far as it can go. We replaced EPS with cash flow as one of our key metrics. And we've created accountability for cash flow at every one of our business units. So we believe that it is a fundamental business truth that sustainable low levels of working capital are a hallmark of a well-managed company. I say proudly but very modestly that we have reduced working capital now for 10 quarters in a row, and the amount of cash that has surfaced has been just phenomenal. We used to spend about $450 million of capital expenditures a year. Today, our managers are living with about 250. And it's not that we're starving our plants. We're just being a lot more efficient and a lot less generous with capital dollars. And a lot of credit has to go to the organization because people understand cash flow. We've all had metrics that measure value, very complicated measures that have been devised by consulting firms, and frankly, we have found that every time we put those in place, our people sit around and talk about allocations, and they talk about who should I allocate this cost to, and this cost belongs to you, and this cost doesn't belong to me. Cash flow is very simple. It's very, very simple. At the end of the month, at the end of the year, how much more cash did you generate? We have very simple formulas, and there isn't anyone in the company that doesn't understand the simplicity of cash flow. In the end, it comes down to execution, and we know that, and it took us a while to get to that. That execution at the end of the day, especially in our industries, it makes a difference. The third element that I talked about is sweat the execution. And it's a not so gentle reminder that execution requires rolling up your sleeves, paying attention to detail, working constantly to achieve harder and harder goals. But it also challenges the idea of sweating the execution, challenges that everyone must have a formal technical sounding acronym for everything they do. When I went to the UK, and we were talking about this a couple of years ago, and I said we have to sweat the execution, I was told later that in the UK, men perspire, women shine, and animals sweat. But we kept on using this thing because at least it got people's attention. The other thing, too, in terms of execution that I just want to point out is this whole idea that companies need a grand 10-year vision. And I can't tell you how many hours and dollars we have devoted to grand visions over the past decades. I've been in this company for 29 years, and I've seen them all grand visions and words and flip charts and people sitting in meetings making sense out of the world in a meeting room. And then how many companies actually stay to a 10-year plan? Maybe some do. And I'm not saying that companies don't, but I can tell you in our industry, there's so many changes within a 10-year period. The business environment changes dramatically. New opportunities arise. Managers move on to new positions and career paths. I mean, how many managers stay in the same job for 10 years? So they write a 10-year plan, a 10-year vision. They get a lot of credit for it, but at the end of the day, 3 years later, they're off in another country, and somebody comes in to do their own vision. It got to the point where every function had their own consultant. And if you went to the boardroom, or if you went to a meeting, and you made a good presentation in front of management, that was 95% of the credit. So what good is execution? I made a great presentation. I told them what I was going to do over the next 10 years. They thought it was visionary. They thought I was really clever. They applauded me. They shook my hand. That's it. That's 95% of the credit. So people weren't getting credit for what they did. They were getting credit for what they said and how grand their presentations were. We believe that a 3-year plan that guarantees visibility, where are we going to make our money? Where are we going to make our money in the first quarter of 2006? Where are we going to do it in the fourth quarter of 2006? Do we have programs set up? Things that are tangible, they're far away enough in the future, but they're close in enough so that you've got to do something today to make it happen. We much prefer that 3-year visibility than a 10-year vision. And that's also helped us focus on execution. In fact, what we've told our people is, forget about 3 years, think about the world in terms of 12 quarters. And plan the 12 quarters out, put activity out, get programs out, get new products lined up, but think of it as 12 quarters, enough to be able to have an impact. And it's remarkable how just a small change like that can focus people again on execution. A couple of other things we did, the organization structure, we are structured around functions. Again, we were a global company, so we had global marketing and global supply chain and global finance and global human resources and global everything. So the people who were managing the business locally were just literally left to dealing with customers. So we stripped all the authority from the business units, went all the way up to the area offices and all the way up to corporate. And if you ask people who had P&L accountability, it'd probably be 2 or 3 people in corporate. But the people managing the businesses did not have the accountability because it was all these global functions that were cutting across and that were making decisions that would impact your business. So the people running the businesses could not be held accountable. So we went back to a simple business unit approach. We have about 50 business units around the world. We have a general manager in each. That general manager and that team's bonus and compensation is based on that business unit's numbers, on that business unit's results, on the metrics we were talking about, net sales, gross margin, cash flow, volume to value, managed for cash. It's all done at a business unit level, and we've actually consolidated as much as we can inside business units. We've got some global departments, but the essence of our organization is now around business units. So we think this creates obviously better collaboration and a lot better alignment. The other thing too is the idea of, global organization allows you to share ideas quicker, which is true. The key thing that we believe we have is a culture whereby people really don't care where the idea came from. So Special K Red Berries was launched in France. In a matter of 18 months, it was in 18 countries. This year, we're going to do a promotion. Just the Spider-Man 2 is coming out, if you haven't heard. And we're going to do a worldwide Spider-Man 2 promotion. Not because it's driven from the center, but because the businesses want it, and the businesses are working together to achieve that goal. And then again, compensation. At one time, we were very much an egalitarian company where if you had a bad year, you'd probably get 80% of your bonus. If you had a good year, you'd get 120. Today, business unit leaders can get up to 200% of their bonus, or they can get 0. And it's all around hitting realistic targets. The last thing we did was challenge our culture, and of course it's not easy because you want to keep things that work from the past, but there are things clearly that you want to change that aren't working for you in the present. But we felt that we had to begin with a cultural change. We think culture is important. Throughout my career, I used to always kind of minimize the importance of culture. I think today it's one of the key drivers of business results in our company. So we redesigned what we believed in. We call it the K values, and we put so many hundreds of people through those programs. The whole idea is that this is just a guide for behavior on how we want to interact with ourselves and how we want to run the business. Obviously, there was some initial resistance to what we had done, but our strategy was simple, very focused, simple to understand, simple for everyone in the company to understand. I think too often strategies are things that, it's the real bright people up on the top floor who are the only ones who can really get it. And what we have found is if we have a strategy that's simply enough to be communicated, and you can get everyone in the company to understand it, then we can have some real power in the organization. I'm not saying we're there, but I can tell you that that's where we're trying to head. So the changes had an enormous amount of planning and work. There were times when I felt like we were cramming like 3 years of work in 12 months, a lot of intensity. But we did restore our competitiveness in categories in the U.S. and around the world. We regained our share in the U.S. cereal category. Our financial results have improved dramatically. Our sales growth has accelerated. Last year we had about a 6% sales growth, which in the food industry, this is 6%, including currencies, about 4% after currencies. In the food business, that's pretty good, believe it or not. So our profitability has improved, and even as we're investing more, we're putting more money behind our brands, we're putting more money behind cost-saving projects, we're able to absorb those in our profit and loss statement instead of having to take this big bath restructuring charge. And that's also part of having realistic goals that give you a little bit of flexibility to be able to manage things like that. Our EPS growth has exceeded our targets in each of the past 3 years. We're generating far more cash flow than we had ever felt possible. And we have reduced our debt in the last 3 years by $1.6 billion. And our stock has performed quite well. Between 2001 and 2003, the compound annual return to share owners, including dividend reinvestment, was about 17%. And that well exceeds our peer group average of about 3% during that time frame. Employee morale has improved, and the organization has embraced changes, and I can tell you there's nothing more powerful than having the organization feel like winners in order for them to embrace change. And I can tell you that there are many people today at Kellogg who are very proud to be in the company and who feel very good about the fact that we are once again winning in the marketplace. So we believe we're a better company than we were 3 years ago. We don't believe we have turned the whole thing around. We don't believe we have performed miracles. We have a long way to go. But as I mentioned before, we're after dependable, consistent, reliable growth, and not some heroic year or some heroic quarter. There are always things keeping us at night, up at night. I know all of us, I know everybody has their concerns. Interesting, my grandmother, my Cuban grandmother, and Cuban grandmothers have the greatest sayings in the world. She used to say that she slept like a baby, even though I know she didn't. And I'd say, what do you mean you sleep like a baby? She said, well, I wake up every 2 hours and start crying. So I sleep like a baby a lot these days. Even though I'm 50 years old now, so I also sleep like a 50-year-old, so it doesn't make much of a difference. But several things. Obviously, we're worried about competition. We're worried about the success of new products. So much of our business depends on new products and innovation. We're concerned about personnel issues. We want to keep our people. We want to grow our organization. We want to have a succession plan. There are always things of an internal nature to keep you up at night. I'd like to just close out with 3 things that are a bit of pet peeves from an external standpoint that we should be talking about and that perhaps not enough is being said about. The first is, everywhere I read about the economy, it seems like everywhere, what you read is that there is no inflation and that we are even heading to a point of stagflation. And frankly, there may be economists in this room, and I have a lot of respect for economists, so please please don't take this the wrong way, but it seems like the only people who are saying there is no inflation are the economists. Because I'm looking at our P&L, and we're seeing healthcare costs going up 15-16% per year. Commodities have been shooting up for the past year and a half, and they're not stopping. Everybody saw the news this morning about the price of oil. Our salaries are going up. So something isn't matching, because there's internal inflation in companies is not matching that number that we see that's being issued every quarter, showing that inflation is 1% or 2% per annum. So that's one thing that I would challenge, and at least in our company, I can tell you our inflation is not 2%. And if you haven't done so, I would just encourage you to look and see how your costs are going up in relation to what we read is the official number for inflation. Left unchecked, I think the healthcare crisis is can be a terrible thing long-term for our country and for the society. It affects productivity, it affects profitability, it affects employment, it affects just about everything. And the bottom line is nothing, not cars, not housing, not clothes, and certainly not food has increased more rapidly in cost than healthcare services. Nothing comes close to that. The other area that frankly is just bubbling up, amazingly so, right in the middle of a Republican administration, we probably have more regulation today than we ever had before. And this was supposed to be an era where we would not have regulation. In the food industry, for example, regulations play a key role in ensuring the safety of our food supply and in having adequate labeling for our products. So a certain amount of regulation is healthy, and you need a certain amount of regulation. Beyond that, though, there are proposals that have surfaced, such as a special tax on snacks, a special tax on advertising, a special tax on foods that are of a large quantity or large serving size. The root problem is obesity, and there is no special magic bullet, nor is there a shortage of dietary recommendations. And you can imagine how confused consumers are. A year ago, we were told, stay away from saturated fats. Then a little while later, they said, no, get away from saturated fats, get away from trans fatty acids. Now, we got into trans fatty acids because we were trying to get away from saturated fats in the 1990s. After that, it was no protein. Then, no fats of any kind. And now it's make it all protein and low carbs. So, and people are trying to regulate this, and people are trying to make some sense out of this. And we don't even have a standard yet for what we mean by low carbs. So, too much regulation, there's too much skepticism, there's a sense that, there are people in the food industry in some room in Battle Creek or in Chicago that are plotting to make obese the population of the country. Or, just incredible things. So that's regulation in the food industry. And then regulation in general is becoming a key factor, almost to the point where I feel sometimes like taking business risk or making a business mistake can be a crime. And we've seen that happen in a couple of cases. And because we've had a couple of CEOs and a couple of companies that have gone off the rail, all of a sudden, business is becoming, or in the eyes of some, has become sort of public enemy number one. which I find very disappointing, very sad, and very wrong. You hear people talking about offshoring. I'm not saying offshoring is a great thing. I live in a small town of 50,000 people. I know it when my neighbor loses his or her job. It's not something that, it's not something we like to do. But I find it incredibly ironic that the world's haven for capitalism is complaining about the capitalist practices of other countries. That the U.S. is actually talking protectionist. It is alarming. And it all of a sudden just changes how, it could change how great our future can be. So, we've done our part to challenge our assumptions, to have a better company, to have a better future. Ironically, even though sometimes in this day and age you don't always admit that you're a CEO. Somebody asked me the other day on a plane, so what do you do? I said, I'm a sales guy for Kellogg, and I just left it at that. But I think it's a great time to be in business. At the end of the day, what's going to get us growing again, what's going to make this continually the greatest country in the world, is that we have the best business people in the world here. I hope you are proud to be in business. I hope you know that you are doing the best thing we can do for society is to make sure that we have a healthy business. If we do that, this will continue to be the greatest country on earth, the strongest economy on earth, and we'll have the proudest business people on earth, which frankly is what we deserve. I want to thank you for being here tonight. It's been a real honor, a real pleasure, and thank you for the time, and it's been great sharing this evening. Thank you very much.
Thank you very much, and the meeting's adjourned.